All right, it's about 1 o'clock. I guess we can go ahead and get started. First, I'd like to introduce myself. My name is Jaron Jenkins. I am serving as president for Black Faculty and Staff Association Ambassadors. Um, and what and what we have going on today is we'll have Renaissance Bank will be presenting a financial literacy event with us to help educate students as well as all those watching on Facebook or online to better manage our finances, go over some topics such as loans and mortgage rates. And how it came across this topic was something I've been more interested in as I got a little older. I actually did an assignment like 2 weeks ago about financial literacy. So this is right on time with that. But and I just think in light of times with COVID changing and mortgage rates and interest rates is something that's very optimal. So without further ado, I'll turn it over in the hands of Mr. Morehead and Mr. Fall.
Thank you. Can you hear me? Have y'all, can you hear me? I just want to make sure I just lost the meeting.
Yes, I can hear you very well.
Okay, great. Hey, good afternoon, Chad, Tara, Jerron, and everyone. Thank you very much for letting us spend a little time with you today to discuss your personal finances. Our goal is certainly to help you come away from this with more information to help you not only now, but also as you move through life and move towards your personal financial goals. We've been fortunate to have been partnered with University Black Faculty and Staff Association for over 2 years now. It's been a great relationship. We've done a number of events and things with them. And again, many, many thanks to Chad for leading and creating this relationship. My name is Kyle Fault. I'm the local city president for Renasant Bank. Our location is downtown between the bridges down on University Boulevard. I wanted to introduce you to the other speakers today. Jarvis Morehead, he is a senior vice president, commercial lender, and involved with outreach with the bank. He is based in Birmingham, but he's very involved in Tuscaloosa with me. He's done a number of things with us. He's also, for example, on the Stillman College Foundation Board. We have Crystal Williams helping us running through the program. Tanya Smith is on with us. She is our local Tuscaloosa branch manager. And Ginger Pennington also, who has done a number of events with us in Chad, and she leads our local mortgage lending team. I wanted to initially, before they get into the presentation, tell you just a little bit about Renasant. You may not be as familiar with us. It's a bank headquartered out of Mississippi. Tupelo is our headquarters. As you can see there, that's the footprint of the bank. About 190 offices with $15 billion. There's not a lot of banks our size these days. There's a lot of small banks. There's the huge banks. We think we fit that niche by being a bank that's big enough to do anything you need, small to give you that local feel, local touch. I'll tell you that if those that would remember the financial crisis from 2008 through to 2012, Renaissance claim to fame would be we were one of the few banks in the country that didn't lose money during that time. We didn't need the federal government or others to come in and bail us out. The bank got through that. So we're a well-regarded financial institution and continuing to grow. I know you probably think a lot of times banks are boring. They just keep up with accounts. They call me when I need money. They'll lend me money. But we're trying to also promote and connect groups and communities so that we can help everyone achieve greater financial success, which does nothing but help all of the economy. So one of the things we reach that through is meetings like this, but also we've established a page called RenaissantNation.com, and it's a pretty cool website. You can go out there and see a lot of different things from some testimonials of customers. As you can see, here's some different things we're sponsoring that are going on, going back into February, going ahead. There's some things out there to give you tips on setting passwords to your emails, which can help you hopefully avoid being financially hacked, which Tanya can talk about that. That's one of the things we do. There's some other things we do. We started 2 years ago a program called Rise with Renasant, which I'm going to move back there. We also sponsor SEC Shorts. Any of those are football fans that have seen those really humorous little short clips about football, usually Alabama winning football games. We have been sponsoring SEC Shorts for 2 years now, 3 years almost. So if you see any of those, we sponsor those. We also sponsor another humorous program that's out there called Things Southerners Say. If you've seen it, it's hilarious, makes fun of us, makes fun of people from other parts of the country that are not blessed to be from the South. But those are things we're just trying to support our brand, increase awareness. Some more serious things we do is something we started 2 years ago is Rise with Renasant, where we're honoring, celebrating, promoting female leadership and women entrepreneurship. Here is an ad that we did for Comay Davis. She is an owner of a business in Hoover, Alabama. And then also we've done some things where we've got customers with unique businesses where we'll do almost like a testimonial or an advertisement for them. And the next slide is of a couple of different things we're doing. One is of Edgar's Bakery, which most people are probably familiar with, and then also Fowler Blades. So we find customers and try to promote their business, which helps us, which helps them, but also just putting information out there for people to be aware with. This is who we are. This is what we do. And with that, I will turn this over to Tanya. I'll also mention if you've got any questions, if you're on there live now, you can chat to us. Chris would take those and we can answer your questions or we can respond back to you. And also at the end, we'll have our information so you can reach out to us down the road if you have a question for us or Tanya or Ginger on the mortgage rate or deposit account. So with that, I will turn it over to Tanya. Thank you again for having us.
Hi, I'm Tanya Smith, and I'm the branch manager at the Tuscaloosa location. I just wanted to say thank y'all again for giving us this opportunity to be a part of your meeting. What I'll be covering is managing your checking account, handling and monitoring your account, reading statements for accuracy, and keeping track of deposits, withdrawals, and other transactions. For me, the best practice is to check my account online every morning. Make this a part of your daily routine so that you can be in front of any situation like fraud that can occur. Use your debit card wisely. Be aware of gas station, hotel, and car rental holds. Most times it's going to be better for you to use a credit card with these situations, but if you do use your debit card, just remember that those funds aren't available until the hold expires. Setting up automatic bill pay. This is a great tool to use. It saves you time and it saves you on getting late fees. Balancing your account. At least once a month, I would go back to the old pen and paper to ensure it's anything. The last thing is overdraft protection. When you set up your account, you're going to have a conversation with the personal banker about being able to overdraw the account. Setting up this is, it can be used for emergencies, but you also would get an overdraft fee. So I would only use that for emergencies. The better option is to apply for an overdraft line of protection. That way you can save on fees and make monthly payments to pay yourself back when you do have to use those extra funds. Keep an eye on your cash. Track your spending. Set alerts through online banking. I have one set that tells me, one alert set up, that tells me when I've reached a certain balance in my account. I have another one that tells me if my debit card is being used in another state. So, your debit card follows the footprint of where you typically swipe your card. So mine is set up to notify me if it's being used somewhere that I would not be or I'm not used to being. Another thing is have mobile banking on your phone. That way you have easy access to it and you can check your account daily. If your bank offers a card app, which may be called something else at your bank, but this is my new favorite tool. It's an app that connects to your debit card that sends you notifications every time your card is used. It shows you when, where, and what your card is being used for. It even tracks your spending, so it helps you keep up with your budget. Also, it has an on and off feature, so if you lose your card, you can turn that card off. This happened to my daughter just recently. She misplaced her card. She called me in a panic, and I told her, hey, go on your card app, click on turn my card off, and it will shut it down. And she was so happy about that because she was so worried that she was going to watch somebody else spending her money. So it's a great feature to have. Thank y'all again, though, for letting us be a part of this. We, again, we're on University right down from the UA, and we would love for y'all to come by anytime, introduce yourselves, and get to meet you. And if you have any questions, we're always here to answer them. Thank you.
What does it mean to be financially healthy? And that's what we're going to continue to talk about this afternoon. True financial health is based on 4 key components: spending, saving, borrowing, and planning. You will notice that each of these aspects of financial health influence the others. If you do not have enough of a financial cushion when you experience an unexpected expense, you will feel as though you're not in control of your day-to-day finances. Similarly, if you are on track to meet your personal financial goals, you will enjoy financial freedom and dignity without constantly worrying about money. By taking charge of several areas of your financial situation, you will improve your overall financial health. Again, there are 4 components of financial health according to the Center for Financial Services Innovation: spend, save, borrow, and plan. These 4 components mirror your daily activities, and based on what you do, will either add or detract from your current and future financial wellness. For example, how well are you prepared for a car breakdown or an unexpected medical bill? Will you be able to go on your dream vacation without having to incur a lot of debt? Creating a budget. Creating a budget is key to spending. In fact, we like to call it a spending plan to determine where you want to spend your money. It might help to determine fixed expenses such as rent, loan payments, insurance, and vehicle leases, and while variable expenses include entertainment, food, utilities, out-of-pocket medical expenses, repairs, and replacements like a computer. This will also help you get a handle on all bills and determine where money is going. Sometimes you will be surprised where your money is actually being spent. Start by reviewing all of your bills and financial institution statements, but also track where you might be spending small amounts of money through your day-to-day course of a month. You will be surprised how that coffee, latte, snack, or sandwich starts to add up. Beware of little expenses. A small leak will sink a great ship. This is a quote by Benjamin Franklin. Variable expenses are likely the spot where you may be able to get control of your overall spending, because that is where you have obviously a little bit more control. Creating emergency savings is a great first start to saving. You may think that you have to save a lot, but starting at even $10 a month, $5 a month is a positive start toward building a savings balance. Once you have set aside an emergency savings plan, the next step is to plan for long-term savings, which might be saving toward a specific goal like a down payment or for a residential home. If your employer offers direct deposits, this is the best place to start because you are creating an automatic savings habit. Another helpful tip: when you get a raise, bonus, or any extra cash, don't just spend it. Put it toward one of your savings accounts immediately and do not even factor it into your spending plan. A sustainable debt load is one that frequently we come out of college and we have some level of debt, whether it's student loan debt or it's automobile debt or credit card obligations. But to have sustainable debt load is one that is not causing you stress in meeting your monthly obligations. If you must use a credit card, make sure to pay it off every month if you can. As a general rule, your total debts, excluding your mortgage, should be no more than 10 to 15% of your take-home pay. With regards to your housing expenses, mortgages, utilities, maintenance, etc., it's also recommended that that amount does not exceed 35% of your take-home pay. But different strokes for different folks. Those are just rules of thumb. So just be very careful that when I give you those rule of thumbs, it may not necessarily be the case for you. Credit can be a valuable tool to help you meet your goals. This is why it is important to understand what credit is, how to manage it, and what you stand to gain from establishing and maintaining good credit. What is credit? Credit is your ability to obtain the goods or services you want now by promising to pay for them later. Your ability to obtain credit is based on your credit history. When you borrow, you are beginning to establish a credit history. This is the record of your credit accounts, your payment history, and the details of how you manage each account. This information is gathered by the three national credit reporting agencies, Equifax, TransUnion, and Experian. And the data is used to calculate your credit scores. Credit scores ranges vary by credit bureau because each bureau has a slightly different score range, but the General's FICO credit score ranges from 300 to 850. Consumer with scores at the highest end of this range is considered to have a super prime credit, and consumers whose scores fall just below that range are considered to have prime credit. For example, Experian classifies super prime credit as a score ranging from 740 to 830, and prime credit score as a score ranging from 680 to 739. Borrowers with prime credit can expect to pay slightly higher rates than borrowers with super prime credit, since they are considered to have a slightly higher risk of not repaying their loans. Having a prime credit score might mean paying 1% more on an auto loan than a borrower with a super prime credit score would pay, for example. And I know 1% doesn't sound like a very lot, but let's take the example of a car. A used car now on average costs a little over $40,000. A used car on average costs just under $27,700. So when you're talking about 1% on $40,000, we're talking about somewhere in the neighborhood of $400 or just below. And on a used car, we're talking about $270. So you can see, and that's actually a year. And you can see how that begins to add up over year 2, year 3, and year 4 when you're repaying a car loan. Having prime credit usually means you can get a new loan and retain access to your existing credit lines, even when the overall credit market is tight. Even in a strong economy where credit is readily available, prime and super prime borrowers see most of the credit that banks can issue. The consequences of having a subprime credit score vary. For some consumers, it will mean having to pay higher interest rates for mortgages, auto loans, and credit cards again. Other consumers may not qualify for conventional loans at all, requiring them to run to riskier and more expensive ways of borrowing, such as payday loans or car title loans. The chart that you're looking at illustrates the different components of a FICO credit score and the percentage of weighing of each component. This is helpful information for you to understand which actions drive your score, both positively and negatively. Your credit score is actually based on those 5 factors that you're looking at on your screen. Your payment history accounts for 35% of your score. This shows whether you make payments on time, have often missed your payments, how many days past the due date when you pay your bills, and how recently payments have been missed. The higher your proportion of on-time payments, the higher your score will be. Every time you miss a payment, you are negatively impacting your score. How much you owe on loans and credit cards make up 30% of your score. This is based on the entire amount you owe, the numbers and types of accounts you have, and the proportion of money owed compared to how much credit you have available. High balances and maxed out credit cards will lower your credit score, but small balances can raise it if you pay on time. New loans with little payment history may drop your score temporarily, but loans that are closer to being paid off can increase it because they show a successful payment history. The length of your credit history accounts for 15% of your score. The longer your history of making timely payments, the higher your score will be. It may seem wise to avoid applying for credit and carrying debt, but it actually hurts your score if lenders have no credit history to review. So at you guys' ages right now, there's nothing that you can do about having a long credit history, obviously, because you don't start to obtain and maintain credit until you're probably 20, 21, 22 years old. So you're not going to probably have a very high weighted average as a response to your history, but you can control when you make those payments on a timely manner, and you can control the amounts that you're actually using by developing and building a budget or having a spending plan. The types of accounts you have make up 10% of your score. Having a mix of accounts, including installment loans, home loans, retail, and credit cards may improve your score. Recent credit activity makes up the final 10% of your score. If you have opened a lot of accounts recently or applied to open accounts, it could suggest potential financial trouble and can actually lower your score. However, if you've had the same loans or credit cards for a long time and pay them promptly, even after payment troubles, your score will go up over time. The longer your history of making timely payments, the higher your score will be. Ultimately, the best way to help improve your credit score is to use loans and credit cards responsibly and make prompt payments. The more your credit history shows that you can responsibly handle credit, the more willing lenders will be to offer you credit at a competitive rate. Keep balances low on your credit cards. You want to keep your credit card balances under 30% of the available credit limit. Pay off debt rather than moving it around. When you do a balance transfer, you may be negatively impacting your credit score in two ways. One, with a hard inquiry that comes from opening the new account, and a second time if the balance is close to the new credit limit. Rather than continuing to constantly move the debt around, it will likely be more effective, obviously, to focus your energy on paying down the balance. Do not close unused credit cards. This is a mistake that I commonly see in my day-to-day activities at the bank. A short-term strategy to raise your scores, that's not going to work. Closing accounts actually may hurt your credit score. Again, it goes to how long have you actually built a history with any of the credit options that you have in your portfolio. That includes obviously credit cards. So don't close out a credit card. If you want to, you can place that card in a drawer somewhere, or you can tear up the card, but don't close the account out because you need that history to build that history. Again, do not open a number of new credit cards that you don't actually need, because it will increase your available credit, but it's only recommended to probably have between 2 to 4 credit cards, but it is important to only open the cards that you actually need. If you open too many cards, you will put yourself in a situation of having too much available credit, which can be seen as a risk to a potential lender as well. And the last thing, please do not file for bankruptcy if you can help it, or get your credit accounts turned over to a collection agency. Again, it's important to develop that budget and develop that spending plan. It is important to note that repairing bad credit is a bit like losing weight. It takes time, and there's no quick way to fix a credit score. In fact, out of all of the ways to improve a credit score, quick fix efforts are the most likely to backfire. So beware of any advice that claims to improve your credit score fast. The best advice for rebuilding credit is to manage it responsibly over time. If you have not done that, then you need to repair your credit history before you see credit score improvement. Make a list. Have everything written out in front of you is really the key to success here. Plus, once you have written it all out and it's right there in black and white, it may not seem as insurmountable as it did before. Make a list of all your debts, name of creditors, interest rate, balance, minimum monthly payment. Also list how much you will need to pay in order to zero out the credit card debt within 3 years. And that information is actually found on your monthly statement. Life throws many unexpected things at all of us. While we usually cannot stop these things from occurring, we can opt to give our lives a bit of protection through appropriate levels of insurance. Insurance is meant to give us some measure of protection, at least financially, should a disaster happen. There are numerous insurance options available, and many financial experts tell us that we need to have these insurance policies in place. Yet, with so many options, it can be difficult to determine what insurance you really need. Purchasing the right insurance is always determined by your specific situation, so it's important to get unbiased advice from a licensed advisor. Some key insurance types that everyone should consider, though, would be life insurance, especially if you have a family, health insurance, even if you're extremely healthy, auto insurance if you're driving around and have an automobile, mortgage or rental insurance, and disability insurance. Planning ahead for expenses starts with budgeting and also getting that emergency savings plan started. I want to emphasize that financial health is a journey and it's not something that has to change overnight. It is also a journey that evolves throughout your life based on your life stages. For example, a single person has different financial health needs than a family or retired person. It is also important for you to know that financial health has nothing to do with how much money you make, but rather maximizing every dollar to the benefit of your financial health. And of course, this outlines what we've just talked about. You're financially healthy when you've been able to spend less money than you're actually taking in, and it's very important. Just as getting good grades in college right now is important, it's important that for a lifetime that you continue to work real hard to always maintain a good credit score. So guys, again, thank you for this opportunity, and we certainly appreciate visiting with you this afternoon.
Hello, everyone. I'm Ginger Pennington, and I am Renaissance mortgage lender on the call today. I'm here to talk to you about one particular loan that we have. We have a community home buyer loan, which is for first-time home buyers. It's one of our favorite loan programs to do. Just to give you an example, it will loan up to 100% of the purchase price. You don't have to have perfect credit. You have to have a minimum of a 640 credit score, so you can be establishing your credit as long as you're paying your debts in a timely manner. And we can talk about, if you were to call us, about the different pieces of credit that you would need. But as long as you have a 640 credit score, you might be able to qualify for that loan. Like I said, it's up to 100% of the purchase price, and you can borrow up to, depending on your income, up to about a $500,000 house. Now, a lot of us starting out are not going to be able to do that on our first home, but if you've not owned a home in the past 3 years, you can also qualify for that program as a first-time home buyer if more than 3 years have lapsed since you've owned your last home. In Tuscaloosa, you can't have over, on that particular program, you can't have over an income for your household of $70,000 per year. So it's an excellent program for a person who is looking for their first home, who does not have a large down payment, but has good credit and looking to get into a purchase now while rates are so low. There are many different types of loans. There's conventional FHA, VA loans, but this is just one that we have that is quite popular. We do a lot of these loans for people who are teachers, young professionals, first responders. It's just a great loan for our community. Thank you.
Am I back live? Can you hear me, John? Okay. We want to thank y'all. If there's any questions anyone has, you can text. Chris was put our emails and our phone numbers out there for you. If there's anything we can do for you now or down the road, we certainly look forward to help. We thank Chad, John, Tara again very much. Look forward to seeing you.
All right, thank you.
All right, thank you.
Can you all hear me? Okay. All right. I wanted to know if you all would kindly something for you. When you were speaking of credit, and sometimes in mortgage, when you fill out the credit application and the student indicates that they completed a degree, isn't there a credit that they get for that, like for 4 years experience? Can you explain that to them? Like when you graduate.
Ginger, are you still on?
We were on mute and we got right
Ginger,
back.
are you still there?
Can you hear me?
Yes, we can hear you now.
I'm not familiar
We
with
were-
credit for getting a degree. Ginger.
I thought that was what they get like for the experience of a job. Like you get automatic credit for 4 years if you got.
We have something similar to that, Chad. What we have is, for example, if they have graduated let's just say they went to nursing school,
Right.
and they graduated school, but they've not been on their job but say a month, and they went to work, for example, DCH. We are able to, because they were in that same field, went to work in that same field, we're able to look at them from that length of time that they had in school as toward their profession, even though they're just starting. So if they were trying to purchase a home and they'd only been on the job for a month, they still could, because they've got some, they do a nursing internship, right? Do some rotation, things like that. And they graduated in the field. We just use their transcripts.
Right. I thought that was the case. And that's helpful for them to know because we have several seniors in our BFSA ambassador group. So I wanted them to know that that's an opportunity. And that's another point of, benefits of graduating from college, especially since we're speaking financial literacy. So thank you so much for that. I appreciate it. Thank you so much.
Thank
I did
you.
have a question for you all. So I know quite a few individuals in the ambassador program have started their own business, and I know in light of COVID, a lot of people have also started their own business. Is there like any advice you can give them in terms of how to finance that?
To finance their business?
Yes. Or the process.
Yeah, yeah, I would recommend, and like Tanya and I, we had talked about stopping by and getting to know where you bank, getting to know the people where you bank. I know so many people feel like going into a bank, it's intimidating. We are trying hard to where it's not. Get to know the tellers, get to know the personal banker, the branch manager, so they get to know you, so that as you're starting to develop things, and hey, so many small businesses start, not just as students, but someone's doing something, it's a hobby, then they get better at it, and they start doing something in the garage or something, or the add-on to the house, or they finally rent a little space. And as you're talking to your banker, that's when it's like, hey, it's time to maybe do this and create the business account. So seriously, stop by and visit where you bank, or call me and we can visit things that, and Jarvis can speak to this as well. Banks, a lot of times when you're starting a business, and if you're in a business where you create work and then you bill them and they'll pay you in 30 days, that's an accounts receivable. And banks can look at lending against that, depending on, the quality of the receivable, the business that's doing the purchase, et cetera. A lot of times people are like, hey, I've got a contract that'll pay me $10,000 if I bill this. I need financing to get that done. That's a little different. That's called a contract receivable. And that's something that you'll get paid once you finish the work. And that's a little bit harder for banks to finance because it's dependent upon you finishing that product. Jarvis will tell you, he and I are not very good at finishing products. We're bankers. So, but there's so many different things there's going on. So a lot of times what people typically do when they start a business, they put a little bit of cash back, or, they take a loan out against the car or against other business assets to kind of support the cash that's needed to pay payroll and just to carry the life of the business. But these days there's so much in technology and things going on that, yeah, we'd be glad to visit with them as they're getting going. Because sometimes as you're growing a business and you're trying to add people and add sales, it takes cash to grow that business. And so kind of getting with the banker early and just saying, here's what we're trying to do is a great idea. And, we're different from the CPA. We don't necessarily bill for our services. So you can stop by and visit with us for a little bit. Our time is free and we'd love to help and visit.
Chad, this is Ginger again. Can you hear me?
Chad, this is Ginger again. Can you hear me?
Let's see. Can you hear me?
Yes.
Okay, I'm sorry. We're still having rain back here.
Okay. Can
One
you?
of the things I mentioned to y'all, some people that have been in school not have any credit whatsoever at this. We also are allowed under that community home buyer program to do alternative credit. So if they've been renting for, say, a year period, and we've got a year's rent, it can be power, phone, it could be, as long as we've got 3 pieces of credit with a 1-year history of good pay, that could go towards their credit. So it's alternative credit, but they don't necessarily have to have a credit score. And I'm finding more and more these days that people don't necessarily have a credit score when they're first getting out of school. So just wanted to run that by y'all too.
Okay, can you hear me, Ginger?
I can.
Okay, we found out while you were getting the feedback. Do you mind repeating that just so that when it replays, everyone can understand clearly what you said? Because that was very helpful information.
Sure, and again, I apologize for earlier. I sounded a little disjointed, but it's because we had ring back.
Oh.
With the first-time home buyer program, I mentioned earlier that you need to have a minimum of a 640 credit score.
Right.
What we're finding these days is that people don't always, when they're first coming out of school, don't always have a lot of credit or have a lot of credit established on a credit report. They may not have credit cards or installment loans, and a lot of people have never purchased their own auto. But if you've been in school and you've rented for at least a year and you've got 2 other utilities, water, power, phone, cable, and they have a year history, or even insurance on your automobile. If you've got 3 pieces of credit that are paid as agreed for a 1-year history, we can use that as a substitute instead of a credit score to help qualify.
Well, that's empowering. I'm sure. Yes. I'm sure many people didn't know that. And since you all are taking questions, I know you said you're gonna put the contact, but I have one for Jarvis because I have adult children. I know your presentation said 2 to 4 credit cards, but what advice would you give the college student who has this nice shiny envelope that's coming in and they open up the mail and it says $10,000 credit? What encouragement would you give them to shred that and not accept that line of credit? Because the marketing for those financial opportunities are great, but it can be very detrimental if the student or the young person is not disciplined in their financial literacy. So touch on that a little bit, if you don't mind.
Yeah, that is a very good question because, Chad, I'm old enough and you're not as old as I am, but I can remember when credit card companies were coming on college campuses and they would give you a $1 or $1.50 t-shirt, and then you would get a credit card and the students would line up from for 2 blocks to get that T-shirt and then get themselves a credit card and find themselves in trouble. I would recommend 2 things, one way or the other. If you're going to get the credit card, only use that credit card in absolute emergencies, because if you don't have the cash flow to pay back that obligation, then I just simply wouldn't I wouldn't even open the application. But if you've got a little job, or you've got income, or you've got money sitting in an emergency checking or savings account, and you want to have a credit card, because it's become a little bit of a challenge to maneuver in our society. You can't rent a car without a credit card. Just some things are just unable to do without a credit card. I would go ahead and get the credit card, but I would put it in a safe place that's not easy to put my hands on very readily, and just be very, very careful, because as I told you, I can remember when they would come to these college campuses, and it seemed like the school only had 13,000 students, but it seemed like there were actually 27,000 students trying to get this T-shirt, and consequently get this credit card. And before they could get off the college campus, they found themselves on the wrong side of being financially healthy. So I talked to my daughter a little bit about it, and I just tell her to be just very careful. I know that she has a stipend, but to be very careful. Make sure that you know what your budget is, understand where your money is going, and just develop a spending plan from time to time. So guys, be very careful, because one of the things that you will know as you go through life is when you start to go for that job, or to
Come on
go
now.
from a job to a career,
Tell the truth.
yeah, frequently those employers will pull your credit report to
That's
try to
right.
get an indication of your financial responsibility. They may equate your financially being responsible with you doing a fantastic job on the job or in the career that you choose. So just be very careful when you make those decisions to open, and then of course maintain good credit.
Yeah, that's actually was going to be my next question, because a lot of students, and not only students, but a lot of adults are not aware that some of these positions, these higher positions, they will pull a credit report on you. And
That's right.
sometimes you can have the greatest degree, or you can have a terminal degree, but if you got a credit score of 300, you're not going to be selected.
That's right. That's right. That's absolutely right.
And there's things that you have to do now to prepare yourself to be successful then.
We talked about earlier about the importance of even having insurance. And you probably asked the question, well, what does insurance have to do with my credit score? Well, insurance firms want to work with people that are fiscally responsible. They don't want to underwrite insurance and turn around and have to spend the rest of the relationship trying to collect premiums every month. So it goes from employers, it goes to renting an apartment. You put yourself in a position where you have poor credit, then you may not be able to live in the apartment complex or community that you would like to live in until you get that fixed. And so when you limit your options, you may find yourself in a place that's not all that comfortable, frankly.
Yeah, thank you so much. You guys, you just don't understand it. You've given some very powerful information. But again, this is not my meeting. We want to thank the 2 advisors, Mrs. Tara Campbell. She's the she's the leading advisor, and Mr. Derek Flowers did join us. He's the assistant advisor, and Mr. Jerron Jenkins is the BFSA ambassador's president. And boy, am I proud of that group, and thank you all for coming through. I'm gonna be quiet because I can ask a lot of questions, because when I was on campus, and even when I was younger, they would send the credit cards with your name on it already, and all you had to do was call in the number and activate it. And it was very challenging not to call in and activate. So I just really want them, if y'all have a few more minutes, students, please do not miss this moment. Okay, we have the top tier professionals on the line. So if you have a question, go ahead and ask. Do not miss this moment.
I actually have a question.
Go ahead.
So someone told me that if you pay your credit card off like twice a month, it'll raise your score faster. Is that true or is that false?
I don't know the answer to that because we're not we're not with TransUnion, Experian, or Equifax, but what information that they have on their websites, and then there's also Fico. What they just say is to make absolutely certain that you pay your bills on or before the due date. And I guess if you pay it twice a month, that would probably be fine. But all I know that it says on their website is to pay on or before the due date, and to try to keep that level of debt to 30% of your overall credit limit. So in the example that Chad gave, if you had a $10,000 credit limit, then do your very best to try to keep that obligation on that credit card $3,000 or less. That way you're doing, then you'll get a better score reported. So just paying it twice, I don't know the answer to that, to be perfectly honest.
So Jarvis, may I ask you something? Because it's been like 4 years since I've been in corporate America. When I was in corporate America, the credit reporting agencies and those that had the FCRA approval, they only reported once a month, right? So if they report your credit once a month, I don't really see how paying it twice is going to help. I know it's a difference between an X and a 1. That you pay before, and 1 is you're on time. But I don't see how that can pretty much speed up the process if they're going to do it once a month. Now, have they changed that?
No, that's a very good point, because Renasant reports when we report it, and it's just once a month. But if you pay it twice, I guess the advantage would be that if on the day that TransUnion, Experian, or Equifax pull your file, on that date, maybe 2 payments have been processed, and so you've actually lowered your outstanding obligation.
Right.
So from that standpoint, it'll help that 30%. It will certainly help, and it'll help that 35% a little bit.
Right. Do you read credit reports?
I do. It's part of the job. We have to read them. We have to pull them frequently.
Right. So you remember the difference between an X, a 1, a 2, and a 3?
Yes.
Can you just give us a snippet of that, just so people would know? And I apologize for digging, but people need to understand when they pull the credit report, you have an X, 1, 2, and a 3. And the person that's reading that credit, you need to understand what they see when they see that.
Yeah, Chad, I'm so glad you asked the question, because I know that Kyle mentions this all the time when we're on these calls. And I want everybody on the call today to remember to go to www.annualcreditreport.com. That's www.annual, for a year, creditreport.com. You can go to that particular website and pull your credit if you have any credit, and you will be able to pull your report, and you can look at the history. And let me tell you, frequently, especially if you have one of those common names, I see Miss Smith on the line. There may be another Miss Smith that has a credit similar to the same name. And sometimes those files can get misconstrued, and it creates issues. So I would recommend that every 4 months that you go to either Experian, either Equifax, or TransUnion, one of those every 4 months, and pull your credit report and see if there's if the information that's in your credit file is correct. To answer Chad's question, what you're looking for when you pull your credit report, you are very hopeful that you have 1s that show that you have been making your payments in a timely manner. If you see 1s and 2s, it means that you haven't been paying the credit card, in my example, or the installment loan appropriately. And the 2 means that you actually missed 1 month. So what you're hoping for when you go to www.annualcreditreport.com, you're hoping to see all 1s, and that's your goal for the next 75, 80 years of your life, is to try to have 1s and not 2s and 3s, because 1 missed payment will ding your credit score. And of course, if you have a 3, that means that you've missed several months. If you have a 4, you've missed even more months, so, and eventually you get to a 7, 8, or 9, and the account can actually get charged off. And as we talked about before, we don't want to get to the point where we have an account that gets charged off and or placed with a collection agency, because that information gets in your credit file and it hurts your overall credit score quite substantially.
And I'm glad you brought that point, because there's a lot of miseducation on charge-off. I was in church one time, and one lady gave a testimony that she had 9 accounts that was charged off. But I think she misunderstood that, that was charged off because you didn't pay. That's not a compliment. That's not a credit compliment.
Yeah.
Yeah, when you get charged off, they sent that to collection. So,
I follow.
Right. So, but again,
I'm sorry, this is Ginger. One other thing I wanted to back up and say, speak to something that y'all were talking about on the credit. Credit reporting agencies, the credit that you have does not always report on the same day like it used to. Now, just say Capital One credit card. It reports on whatever date the statement drops. If it's the 8th, it reports 2 days later on the 10th. So it depends on, and Jarvis can speak to this, they don't all report on the same day. So some people that are looking to, and credit is a snapshot. So just because you have charged, just say you spent $100 on your credit card, if you paid it off in that month, but you paid it off before they took the snapshot, it may show a 0 balance. But if they reported on it, it may show 100 regardless of when you paid it. So Jarvis can talk to that, but they report 2 days after the statement drops.
That's good, Ginger. That's good. And lastly, so one other thing, and I promise I'm gonna be quiet this time. I see a lot of young people getting drawn into co-signing for relatives and co-signing for friends and co-signing for those that they're in relationships with. Since we were speaking about the credit and the numbers, so a co-signer, that means this person has a 3 or 4 or 6 or 8 that they cannot sustain credit by themselves. Can you cover why that's a no-no in every situation to do a co-sign unless you're married to the person and has been married to them for 19 years?
I'll just start, and anybody can chime in. I would tell anybody, and this is Jerron asked about a business loan, and it goes for both business and consumer. But I wouldn't recommend anybody to have someone use their credit unless they were prepared to make those payments each month. The only way to handle something like that is to realize on the very front end that you're probably going to end up paying this loan back, and that maybe the way to actually do it is that you make the payments and that person reimburses you so that you know that the payments are being made in a timely manner. If someone can't get credit on their own, then there's probably, as Chad hinted, there's a reason that they can't get it. And you probably don't want to put yourself in that position thinking that you're just helping them get this innocent credit card. But just know that when they get that innocent credit card, that you're also very much obligated, and it will adversely affect your credit if that credit card is, in our example here, is not paid as agreed. It will adversely affect your credit as well. So I would tell anybody that if you can prevent from guaranteeing, endorsing, putting yourself out there, I would absolutely not do it, because if that person is not paying that loan back, then it's going to adversely affect your credit.
Agreed. I've heard many times people say, well, I just co-signed for that. When you co-sign, you are responsible.
And it also shows on your credit if it lists you as just an authorized signer. So if someone puts you on their credit card as only an authorized signer still reports to your credit bureau.
Wow. Wow. I know we did a lot of talking. Taylor, did you feel like we answered your question?
Yes, you all answered it. Thank you.
Thank you. I just want to make sure you were covered. Anyone else? Well, this has been great. Jerron, is back into your hands, sir.
Right, so if there's no more questions, I'd like to thank you all, Renaissance Bank, you all for sharing your knowledge and answering our question. It was very helpful and insightful, and hopefully everyone who is watching now or will watch later on Facebook is able to take something from this and hopefully better establish their own credit. Once again, I'd like to thank you all, and I guess that just concludes it.
Thank you.
Thank you.
Thank
you.